and scroll over to the credit. That's a credit. That's a credit. It's going to go up in the credit direction. Put us back in balance. No effect on net income. So then we're going to go to 1216. Sent a reminder to the company to pay the fee for services rendered on November 8th. So we're sending out. We're saying, hey, could you pay us? Now notice that we already earned the revenue. We haven't received the cash. So this is kind of a tricky one. There's no journal entry at this time, but we're just sending out reminders. That's something that would commonly be done within the business setting to try to collect, obviously, on our receivables. Okay, 1220. Completed a project for Lou Corporation and received $6,325. Okay, so is cash affected? Yeah, we received cash. Cash is a debit balance. We're going to make cash go up by doing the same thing to it, which in this case would be another debit. So cash is going up. 6320. We're going to have to credit something. What are we going to credit? Why did they pay us cash? Because we did work. When did we do work? Now. So we received cash because we earned the revenue. Now the credit's going to go to revenue in this case. Notice it's in order. Assets, then liabilities, owner's equity, revenue. Is here on the income statement under the owner's equity section. The revenue account has a credit balance, and we're going to credit it again. Note, revenue only goes up. Revenue does not go down. If we do work, we get paid, or we don't get paid maybe, but we don't get negative paid. We have expenses incurred in the work, but revenue itself will go up. Net income can go down, but revenue generally goes up. So there we have that, and now we're going to post this out. So I'm going to double click on the cash. I'm going to go to the end of it, go plus, put your cursor on the debit and enter. Cash goes up, and then we're going to go to the revenue account in cell M20 equals, and go down here to the credit. That's a credit, that's a credit. They're the same like things, therefore that's going to make the credit go up here, put us back in balance here. Net income will be affected in this case, it will go up. So we got more revenue, cash went and bringing the net income up. So then we're going to go to 1228. Received 3007 cash from Gomez on its receivable. Is cash affected? Yeah, we received cash. Cash is debit balance. We need to make it go up. How do we make something go up? We do the same thing to it, which in this case would be another debit. We're going to debit the cash. And in this case, we did work, but we did it in the past. Therefore, we have already recognized the revenue in the past. We're not going to credit revenue. We've already credited revenue. What we're going to do now is credit the receivable, meaning someone owed us money. They owed us 8768, multiple people most likely, and now they have paid us, and therefore this has to go down. How do we make something go down? We do the opposite thing to it, which in this case would be a credit. So the amount being 37 and a credit of 37. So if we post this, then let's see what happens. I'm going to double click. I'm going to go to the end of this. I know there's a lot in there, but notice we're just posting the cash accounts. We're going to go to the end plus, and then we're going to click on the cash here, and there all the cash accounts are reflected. If we get out of balance, notice we can use these indicators once again to see what is in there. We can also double click and see the highlight in there. If you want to know where these are at, they're in the data group, and they are, sorry, in the formulas group. I always do in the formula auditing section right here. So those can be useful. Okay. Now we're going to post the receivable. So I'm going to double click on the receivable, go to the end of it, plus, here's the credit. This is a debit, that's a credit. It's going to make receivable go down, and that'll put us back in balance. No effect on net income. So now I'm going to unhide these cells. Remember, we hid these cells. We have A, B, C, D, J. It doesn't go along there. So we're going to put our cursor on the D, left click, and then drag to the K. Unclick, right click on the selected cell, and unhide. And then if you want, you can hide these. We don't really need these here, so I'm going to put my cursor on like the E. So it looks like that. Scroll over, right click on the selected, and hide. Okay, so then we're moving to the 1229, which says reimburse SRAI for business automobile mileage for 600 miles at 32 cents a mile. Okay, so is cash affected? In this case, yes. So what's happening is we're paying the owner for the mileage that was used out of the personal account. So we're taking it out of the business account and paying it basically to the personal account. So the business account is going down. So cash is a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit of, I'm going to put a negative and do this calculation of 600 miles times 0.32. 32 cents means we're crediting $192. We're going to have to debit something 192. And if we look down here, we see in the expenses areas, we see a mileage expense. Now, if it was me, I would just call it auto expense, but we got it called mileage expense. So anyways, all the expenses have debit balances here. They only go up, and we're going to make it go up by doing the same thing to it, which is another debit, which we already knew because we had the credit to cash here. So let's post this out and see what happens. And I'm going to post the cash first, even though it's on the bottom. Double click it on cash, go into the end of it, plus, and then go into the credit and cash and enter. Then I'm going to scroll down to the mileage down here in cell M28 and N equals, and go up to the mileage here, the debit, that's a debit, that's a debit, that's going to make the debits go up, put us back in balance, bring net income down. And remember, net income, how's it calculated? Income, revenue, minus expenses. The credits minus the debits, meaning the credits are going to win, hopefully, if we have income. Okay, so then we have 1231. And the owner withdrew 1,300 cash from the company for personal use. Okay, so is cash affected? Yes, the owner took it out, therefore the cash is going to go down. How do we make something go down? We do the opposite thing to it, which in this case would be a credit to cash of 1300. We're going to debit something. What are we going to debit? Well, who took it out? The owner. So we're going to go to the owner's equity section, which is represented by the blue area because it's separating the balance sheet from the income statement. And we have a withdrawal here. So withdrawal is a little bit funny one because remember, owner's equity has a credit representing that we owe the owner. And the draws are going to have a debit because they are going to roll into the cap of the owner's equity total account here. So what's happening with the draws is it's bringing really the total owner's equity, which is all this, down by going in the debit direction. So we're going to debit it, which will make draws go up, which makes totals owner's equity go down. So I'm going to copy that. And notice that that's a bit confusing, that we can first start realizing that by seeing that we credit cash. Therefore, we have to debit the withdrawals. Then think about why we have to debit it. Okay, so then we're going to go to cash, going to double click on it, going to go to the end of it, plus, and then we're going to go to the cash and enter. That brings cash down, puts us out of balance. Then we're going to go to the withdrawals, equals, and then go up to the cell H9 and enter. The draws goes up, which brings basically the net owner's equity, this minus this, down. Okay, and then notice there's no effect also on net income here. So a lot of times when people make mistakes here is where the owner took money out and basically expensed it, which would bring net income down, which is not good for tax. Anyway, so then we're going to go to the next one. Let's see what else we have here. The following additional facts are collected for use in making adjusting entries prior to the preparing financial statements for the company's first 3 months. So now we're going to do the adjusting process. So those transactions were what we did as of the end of the month. Now we're doing the adjusting entries. So this is the adjusting entry, draw a line in the sand here. We're doing something different now. There's a different set of rules, which are this. Every adjusting entry is going to have a balance sheet account and an income statement account for the most part, and they're not going to include cash in them. So cash is not generally going to be affected in the adjusting process, and we're going to have a balance sheet account up here and an income statement account below the blue line here, and we know that income statement accounts generally only go up. So using those rules, we're going to apply out the rest of this problem. So we have A, all these transactions happen as of the cutoff date, which is 12/31. So we have the December inventory count for the computer supplies shows 580 still available. Okay, so what we're going to do before we even think about it, we're just going to say, well, supplies is what we're thinking about. So if I take a look at the accounts in the balance sheet related to computer supplies, that must be computer supplies. So it's going to be that one. I'm just going to highlight it for now. Say we're going to use that one. And then if I look at an income statement account below the blue line, we're going to do something with computer supplies. Go, looks like that one. So we know, we can basically see that those two accounts are affected. And we know that this is an expense account, and we can see that all expense accounts here have debit balances. They only go up in the debit direction. Therefore, we're going to have to do the same thing to it, which is a debit. So I'm going to debit computer supplies expense, and that means that we must credit the other one. So I'm going to copy, I'm going to credit this one. So we know that much. We know which way they're going without even knowing really what we're doing here. So now what are we doing here? What happens on this is similar to our calculation for inventory, meaning we're going to just tell the bookkeeper, every time you buy more paper or whatever supplies we have, you just keep debiting computer supplies. Then monthly, we're going to go in there and count the amount of paper that is still left, and we are going to reconcile the supplies by decreasing it for the amount that is still left, similar to us just counting the inventory and making it correct on a periodic type basis. So what happened is we're saying that the count of the inventory is now 580, and we have 4545 in the supply. So minus the 580 means that we need to make an adjustment of 3965 in order to get this down to 580, which is the physical count that we did at the end of the time period. So I'm going to do that calculation again here. We said equals the 4545, the amount that's in there. And notice you might be tempted to do this. I'm just going to point this out. You might be tempted to say this minus the 580. And I'm going to show you why you can't do that. I mean, if you then post it, we're going to post it here and say plus this number, and this should bring this up. But it says, oh, careful, we found one or more circle references. So what's a circle reference? We're basically saying, I want you to use this number to do this calculation, and then I want you to use this number to change this number, which is used to make this number. So the system's saying, well, you can't have me using this number to do this calculation and then use that number in order to change the number that you just used to change that. So that's a circle reference. It happens all the time. So we can't really do that. Therefore, we have to hard code it this time. 4545, and there we have it. Okay, and then the credit is going to be here. I'm going to delete that for now. Okay, and the credit's going to be here. So I'm going to double click on this. I'm going to hit plus, and this should actually be the credit. So the credit of I-13, enter, brings the supplies down to the 580. Then we're going to go down to the computer supplies expense here, equals the computer supplies expense. It's going to go up in the debit direction, put us back in balance, and bring net income down. Okay, so then we're going to go to number B, or letter B. Letter B. Okay, 3 months have expired since the 12-month insurance premium was paid in advance. Okay, so we have the insurance premium. Well, let's do this. So since we are in the adjusting process, we're going to go through our questions here. The questions being, there's going to be one balance sheet account other than cash related to insurance. We look through the accounts here, we could say, there's prepaid insurance. So let's say I'm probably going to do something with that. There's going to be one income statement account below the blue line in our adjusting process entries related to insurance. Insurance expense. Okay, so we know that. And we know that these are all expenses, and they only go one way. They go up, and they all have debits. Therefore, it's going to have to go up in the debit direction by doing the same thing to it, which in this case would be another debit. So we're going to debit the expense, which means we must be crediting the other account, which is this account. So once again, if you go through that questionnaire, you can see which way the accounts are going without really knowing what we're doing. Now let's talk about what we're doing. So one of these accounts are prepaid insurance. It's an asset. How do you know? It's up in the assets section with all the other assets. And what is prepaid insurance? Well, when we buy insurance, we have to credit cash, and then we have to debit something. Why don't we debit the insurance expense when we buy the insurance? Because by definition, insurance has not helped us yet. Insurance is a coverage in the future. So therefore, when we buy insurance, we're really buying something that we're going to use in the future. And under the matching principle of the accrual principles, we should then put it as an asset and then write it down as the expires of the insurance happens, because that's when we're actually consuming it in the same time period that we're earning the revenue. So that's the matching principle. So what we're saying here is that the insurance has 1860 in it, and we're saying that it's a 12-month policy, and now 1 month has expired. So I'm going to divide that by 12, and okay, 3 months have expired, not 1 month. So let's do this in a calculator first of all. So we've got the 1860, and if we divide that by 12, we get a monthly total. And it's telling us now that 3 months have expired. So it would be 155 per month times 3 would be these